Good afternoon and welcome to the third Melbourne Institute colloquium for 2021. My name is Roger Wilkins and I'm the Deputy Director of the Melbourne Institute. Before we begin, I'd like to acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples here today. These colloquia replace our normal face-to-face forums and workshops. Although it is possible we will continue them even when we reinstate our face-to-face events. Our goal is to provide insights of Melbourne Institute researchers and to also engage with you, the audience, so we can better understand Australian economic and social policy issues. Today we have Dr. Antonia Settle, who will present research using household expenditure data to examine how household insurance expenditure responds to the onset of financial stress. Antonia is a Mackenzie postdoctoral fellow at the Melbourne Institute. Her research examines household risk and is focused on the implementation of a financial diary study in Australia. She has a PhD from the University of Sydney, which she undertook in the Department of Political Economy, and her doctoral research examines central banking and household risk. Antonia will speak for approximately 30 minutes. This will be followed by 10 to 15 minutes when questions and comments from the audience will be addressed. A note about how we're handling questions and comments. For those of you watching through Zoom, we are relying on the Q&A function found at the bottom of your screen. For those of you watching through Slido, you can submit questions in the box on the right-hand side of your screen. You can submit questions at any time through these functions, and then I'll relay them to our speaker in the Antonia in the Q&A time slot we have. So with that, I'll now hand over to Antonia.
Thank you, Roger. I'll just get these slides up. Okay, thank you. Thanks to the audience. Thank you, Roger. I'm presenting a study today that examines changes in expenditure at the time a household enters into a period of financial stress. The study asks what happens to household expenditure when households enter into financial stress, which payments do households cut and which payments do households preserve. In particular, the study looks at what happens to insurance spending when households tighten their belts. Is insurance spending treated as a necessity or as discretionary spending? And how do these choices vary between different types of households? So this is an important question because financial stress is important. It's a changing problem, an increasingly important problem. As the Pulse of the Nation survey shows, around 1 in 4 Australian households report that they're in a state of financial stress. Indeed, changes in the labour market and social policy, not to mention rapidly rising housing costs, mean that households right up and down the income ladder are much more vulnerable to financial stress than they may have been in decades past. There's a large body of academic research which teases out the problem of financial vulnerability, and much of it focuses on what the OECD calls the squeezed middle class. So financial stress and financial stress in the middle income bracket is increasingly on the agenda, but the question of how financial stress interacts with insurance demand is little explored. So questions about how demand for insurance changes as financial stress becomes a more common feature of the economy is also important because insurance plays an important role for individual households and for society as a whole. The availability of private insurance protects households from various insurable risks, but it also builds resilience for the wider economy. Consequently, understanding the dynamics of insurance and in that the dynamics of household demand for insurance is important for strengthening wider economic resilience. The analysis undertaken here is also important because the insurance sector itself is under considerable strain in Australia. We see this in house insurance, we see this in health insurance and in life insurance, where for various reasons premiums are rising because profits are under pressure. So this context raises potential vicious cycle dynamics. If household demand for insurance is changing at the same time as we're seeing shifts on the supply side. At issue is the possibility that households may not accommodate higher premiums as a necessary household cost, but may increasingly see insurance as discretionary spending. And this raises far-reaching issues for households and the economy as a whole. So before we have a look at the data, I want to outline some basic details of the study. As you mentioned, Roger, the study uses household expenditure survey data. The household expenditure survey is collected by the Australian Bureau of Statistics, and it covers approximately 10,000 households in each wave. The sample is representative of the wider public, and the data that I'm using today combines both the 2009 and the 2015 surveys. It's not panel data though, so they're different households, but we've got the double sample there to make the sample larger. So the survey looks at what households spend in a given period and extrapolates that into a figure for annual spending on a vast array of spending categories. And the survey also includes a set of financial stress indicators. So there's 12 different financial stress indicators, which cover an array of financial stress and missing out experiences. The most common, for example, is inability to afford a holiday for at least 1 week per year. Other common ones include things like inability to raise $2,000 in a week, or inability to pay utility and phone bills on time. This data is used in the study that I'm presenting today to compare the spending of stressed and non-stressed households, that is, households with one indicator of financial stress, stressed households, and non-stressed households, those who report no indicators of financial stress. So if these two sets of households are similar in other ways, then comparing spending between non-stressed households and those with one indicator of financial stress will capture any change in spending as households enter into financial stress. That is, we can see where stressed households make cuts in their expenditure. Hence, the analysis takes groupings of households that are similar in terms of income, demographics, and housing tenure, and looks at what happens to insurance spending amongst those households when they're in the very early stages of financial stress. It's important to note that the analysis excludes households that are in a state of entrenched stress. So the analysis compares those who report no indicators of financial stress, which is around 60% of Australian households, with those who report one indicator of financial stress, those in the early stages of financial stress, and that's around 15% of Australian households. The other 25% of households who report more than one indicator of financial stress, so often that's those in an entrenched state of stress, those households are not relevant to this analysis. We're looking only at households who are fairly stable in financial terms. So let's have a look at the first graph here. What we've got here is annual spending on various insurance categories amongst households in the early stages of financial stress, so households with one indicator of financial stress, and those with no indicators of financial stress. We see here that households spend the most on private health insurance, the first set of bars there, but that non-stressed households spend over $2,000 a year on medical insurance, whereas households in the early stages of financial stress spend closer to $1,500 per year. This is roughly consistent across home and contents insurance, the second set of bars there, life and sickness and personal accident insurance, although is less pronounced for car insurance. So households in the early stages of financial stress spend around 25% less on insurance than non-stressed households, except for car insurance, where the figure is more like 10%. This suggests that households are cutting insurance when they enter into financial stress. So we'll now go into a little bit more detail. From here, we'll cut out life, car, and sickness and personal accident insurance, although we will return to the full set of insurance expenditure in the final slide. For now, though, we'll focus on the two biggest insurance categories in terms of household expenditure, and that's medical and house and contents insurance. So figure 2 here compares insurance spending between stressed and non-stressed households within different groupings of households. Here we're looking at medical and house and contents insurance combined into a single figure for insurance expenditure. The grid line at 100% represents the spending of non-stressed households. So the bars show how close these different groupings of stressed households come to spending 100% of what their non-stressed counterparts spend on insurance. This shows that middle-income households exhibit the most consistent patterns of reduced expenditure on insurance in the early stages of financial stress. So the blue bars compare households in different income brackets. This shows that there is little difference in insurance spending amongst households in the bottom income bracket. These low-income households spend roughly the same amount on insurance, regardless of if they're in the early stages of financial stress or are experiencing no indicators of stress at all. That is, stressed households spend 100% of what non-stressed households spend. All other income groups show some reduction in insurance spending in the early stages of financial stress. However, it's the middle income group that drop their insurance spending the most. This pattern is even stronger for middle income groupings that are not only alike in terms of income, but also in household composition, housing tenure and employment status. So the teal bar there shows that working middle income households that are in the early stages of financial stress and have dependent children spend 22% less on medical and house and contents insurance than their counterparts who are not financially stressed. And then the pattern is broadly the same for middle income working households who rent or pay mortgage, represented in the dark blue bar. Finally, the grey bar represents non-mortgaged homeowners. Financially stressed non-mortgaged homeowners actually spend slightly more than non-stressed households on insurance. So these patterns imply that reduced insurance spending amongst stressed households, doesn't happen because those households have different needs for insurance, such as fewer children that will need dental care, for example. Nor is the cut in insurance simply the result of income differences, such as where, say, poorer financially stressed households might spend less on insurance than wealthier non-stressed households. Given that the stressed and non-stressed households that are compared in figure 2 are otherwise similar in terms of income, family structure and housing tenure, the data suggests that it is financial stress that is driving these households to reduce their insurance expenditure. One point of methodology that I'll clarify here is that those teal and dark blue bars combine the second, third and fourth income quintiles into a subsample of middle-income households with dependent children and middle-income households who rent and pay mortgage, respectively. But the comparison of spending by financially stressed and non-financially stressed households is taken within each quintile and then combined. So this ensures a big enough sample to find reliable results while guarding against the possibility that the results are skewed by the overrepresentation of one group in one of the relevant quintiles or the underrepresentation of another. We'll break these figures down in a bit more in the last slide, but first I want to turn to contractual payments. So a key feature of both households with dependent children and households who rent or pay mortgage is that they tend to have high fixed costs. So these households are usually midlife cycle, so they're often building equity in their homes in real estate or sending kids to childcare or school, for example. But with high fixed costs, households are stuck in certain spending patterns that aren't easily adjustable. The hypothesis here is that reduced insurance spending amongst middle-income households may reflect limited options for cutting expenditure amongst high fixed payments. And indeed, those that reduce their spending on insurance the most when they enter into financial stress are also those with the highest proportion of spending devoted to fixed payments, such as rent or mortgage, childcare fees, locked-in phone and internet plans. And we see that here. So figure 3 shows that contractual payments are particularly high for working middle-income households who rent and pay mortgage and those with dependent children. So across the second, third and fourth income quintile, fixed costs are consistently around 30% of all spending for these two middle income groupings. These are costs for mortgage and rent, it's water and sewerage, so rates on water and sewerage, local government rates, interest payments, childcare, education excluding HECS, internet and mobile phone bills, and that's because there's often a consumer credit component of those bills, and it's a fixed contractual payment, and also costs associated with any other property. So this portion of fixed payments in total spending is lower for households in general. That's the grey bar there, at around 20%, and lower still for non-mortgaged homeowners, which are in teal. So remember, this last group is not necessarily working. Non-mortgaged homeowners are commonly retired, so they usually don't have to worry about childcare and school fees, and neither rent nor mortgage. And they only spend around 10% of total spending on contractual payments. So this suggests that the kinds of households that tend to be stuck in the tightest spending patterns are also those that cut their insurance the most when they enter into the early stages of financial stress. So we can see this here in figure 4, where we have expenditure by stressed households as a percentage of expenditure by non-stressed households within the groupings of working middle-income households with dependent children. That's the first blue bar there. And working middle-income households who rent or pay mortgage, the dark blue bars. And we've also got there non-mortgaged homeowners, the teal bars. So again, we're looking at that 100% grid line. The figure shows that middle-income households with dependent children who are in the early stages of financial stress spend about the same as, that is 100% of what non-stressed middle-income households with dependent children spend on basic food. We see that that's the same for electricity, the same for gas, and the same for petrol. Similarly, for households who rent or pay mortgage, spending is broadly the same. Stressed households spend around 100% of what non-stressed households spend. And the same again for non-mortgaged homeowners. Stressed households spend the same as non-stressed households on basic food, electricity and gas. Yet when it comes to recreation, we see a drop closer to 90% for households with dependent children and those who rent or pay mortgage. By contrast, non-mortgaged homeowners in the early stages of financial stress spend 98% of what their non-stressed counterparts spend on recreation. As for insurance, these figures are below 80% for households with dependent children, and similarly for renters and mortgagees. So that is, households in the early stages of financial stress spend less than 80% of what non-stressed households spend on medical, house and contents insurance. Again, this is not the case for non-mortgaged households who spend broadly similar amounts regardless of if they're stressed or non-stressed. This suggests that middle-income households reduce expenditure on insurance when they enter into financial stress because they have limited discretionary spending capacity left after meeting fixed payments. Hence, we see middle-income households effectively treating insurance as discretionary spending rather than as essential coverage to counter risk exposure. Indeed, figure 4 shows that households in the early stages of financial stress tend to reduce expenditure on recreation, from holidays to televisions and camping equipment, yet their expenditure on basics is, if anything, higher. Thus, financially stressed households reallocate spending away from both luxuries, recreation and insurance, while maintaining spending on things like electricity, petrol and basic food items. When we take this together, the data shows that households wind back their spending on insurance and recreation to free up income to put towards fixed payments, such as housing, childcare and school fees, as well as interest payments, internet and phone costs. Yet as households downgrade insurance coverage, underinsurance compounds the effects of financial stress by exposing households that are already under some kind of stress to the risk of greater financial calamity. So we'll have a look now at the more detailed data. The last slide breaks these figures down. It's very hard to read the labels because they're so small, but all we really need to see is the patterns in the bars. So here we have annual expenditure in dollar terms for all 5 categories of insurance for each quintile of each of these 3 key subsamples. Working households with dependent children, separated into second, third and fourth quintiles, working mortgagees and renters, separated into second, third and fourth quintiles, and the same for non-mortgaged homeowners. We also have the sample size for each group in the legend, which is very difficult to see, but there nonetheless. So the panel on the far left begins with annual health insurance expenditure for working households with dependent children in the second income quintile. So the very first bar on the left there is the dollar spend of non-stressed households on health insurance, and the second bar is the dollar spend of stressed households on health insurance. And we're just looking at the second quintile for households with dependent children. So there's a clear step down from spending by households who are non-stressed, that first bar, to spending by households who are in the early stages of financial stress, that second dark blue bar. The third and fourth bars on the far left panel, that's the grey bar and the light blue bar. These are also households with dependent children, but these are households with dependent children in the third quintile. So again, we see that step down in the spending between non-stressed third quintile households with dependent children, the grey bar, the third bar there from the left, and stressed third quintile households with dependent children, the light blue bar, the fourth bar from the left. And again, for the fourth quintile, we see the same. So in each case, stressed households spend less. The next set of bars is for house and contents. Again, every second bar is sharply stepped down. Before I turn to car insurance, let's just look over at the panel on the far right, where we have the same breakdown of data for non-mortgaged homeowners. Here, there is clearly no consistent stepping down pattern between non-stressed and stressed households. Interestingly, we also don't see the stepping down pattern for car insurance for any of these samples. This suggests that households do in fact see their car insurance as core non-discretionary expenditure. And it's not hard to see why. Car insurance is cheaper, not a lot cheaper, but still somewhat cheaper, and it covers a risk that's much more present. As for sickness and personal accident insurance, reduced expenditure among stressed households doesn't occur in the second and third quintiles of households with dependent children, but it does occur for all other quintiles. We also see that stepping down pattern, life insurance expenditure. These have been excluded from the analysis though, because they're not very common forms of insurance, so the results aren't as reliable. So I'll now give a quick summary of some of the implications of the findings before I finish. I'll leave us with this slide. Basically, we've got a number of issues that are raised by these findings. So firstly, the findings suggest that underinsurance may be more strongly associated with financial stress than is conventionally accepted. So the data show how financial risk associated with financial stress can be compounded by underinsurance when households reduce their insurance coverage as they enter the early stages of financial stress. Hence, for those households that are unlucky enough to experience a shock at the point at which they're underinsured, for example, a health shock or an adverse weather event that causes damage to their homes, For those households, the early stages of financial stress may prove a tipping point into a much deeper and more persistent order of stress. A household that cuts their home insurance after being pushed into financial stress due to job loss, for example, may never economically recover if they have the misfortune of having their home burned down in a bushfire at that point when they're underinsured. So the early stages of financial stress thus might be much more dangerous than is conventionally assumed. In other words, risk exposure may in fact rise precipitously when households first enter what is otherwise a relatively mild state of financial stress. We're talking one indicator here. So this is important when households right up and down the income ladder are known to be much more vulnerable to stress. So there's been much work on what the OECD calls the middle income squeeze, by which middle-income households are squeezed between unstable work and rising costs, especially in housing, which leave households vulnerable to shocks. A part of this set of developments is the increasingly common occurrence of wealthy hand-to-mouth households, so households that are asset-rich but cash-poor, which leaves them with little room to move if they're unexpectedly faced with a big cost or with reduced income, such as in the case of illness or family breakdown or job loss. As slim buffers become more common, households more easily slip over into financial stress. So the data analysis presented here suggests that those households risk tipping into sustained financial stress. The findings also suggest that households consider insurance as discretionary spending and view risk coverage as a luxury. This strikes a contrast to the conventional view in the finance literature, where the puzzle of insurance as an inferior good in compliance with the decreasing absolute risk aversion hypothesis is resolved with insurance posited a normal good. The findings presented here suggest that insurance might be more correctly understood as a luxury good in certain circumstances. And this in turn implies weakness in the capacity of insurance to effectively support resilience in the economy, insofar as insurance falls short of providing complete markets, even in relation to the most applicable of risks. Where insurance is seen as a luxury rather than a subsistence cost, we see the failure of private insurance markets to provide consistent protection to households from shocks. Whether we place the blame on households for failing to rationally manage their risk exposure or not, the fact remains that insurance is apparently not adequately defending households from risk. And this is a potentially important macroeconomic problem. And this is all the more important, moreover, amidst the increasingly challenging outlook that the insurance sector faces. In Australia, increasing strain on the balance between profitability and affordable premiums poses an uncertain future for the house, health and life insurance sector. In short, coverage is increasingly being rejected by households who deem premiums too high. Yet insurance companies cannot turn a profit without raising premiums. There's different reasons for this across the different types of insurance, but climate change and house insurance is an obvious and pressing problem here. The result is less households paying for insurance, which in turn raises selection problems for insurance providers. Providers are faced with the exodus of low-risk households who deem higher premiums poor value for money and greater concentration of more expensive, high-risk households who deem higher premiums still worth the expense. In response, insurance providers are forced to raise the cost of premiums, but this in turn prompts more low-risk households to drop coverage. If insurance is deemed by households as discretionary spending, as a luxury, then they're less likely to accommodate rising premiums and keep paying even as costs rise. Yet, as more households reduce insurance coverage, difficult questions arise about how the costs and profits of protecting households from risk should be equitably divided between the public and private sector. The 2020 bushfires on the East Coast prompted a rerun of debates that were familiar from the Black Saturday bushfires, by which government support for uninsured households was seen as creating moral hazard that disincentivises households to fully insure their homes. We see similar debates following the recent floods. As underinsurance becomes more widespread, this becomes an ever more pressing problem. The problem really is that insurance is a risk-pooling device, but it works best as a society-wide measure. This requires households to see insurance as a necessity, not as discretionary spending. Once there are large gaps in insurance coverage, the system breaks down. There's no easy solutions here, needless to say, but these very difficult questions will become increasingly unavoidable as widespread economic shocks drive more households into a state of underinsurance in a context of higher premiums and, at least in the case of house insurance, higher risk. Thank you. I'll pass it back to you, Roger.
Thanks, Antonia. So we now have time for questions from the audience, and I remind you that you can use the Q&A function if you're watching in Zoom at the bottom of your screen, or the at the box next to the viewing area in Slido. I guess a question that really comes to my mind is, you're comparing households that are similar characteristics and they have similar income, and then and the immediate question that comes into my head is, why is one in financial stress and the other not? What are the sort of reasons? And that one household is in financial stress and another similar household is not, and is that relevant to our understanding of this phenomenon, and perhaps what the appropriate policy responses are?
Yeah, look, that's a really important question, and I think that that's part of why this kind of research is important, because we see an increasing recognition. I mean, there's an increasing amount of research on financial stress that suggests that financially stressed households are ordinary households. It doesn't take a lot for households to slip into some form of financial stress. And what we're looking at in this paper is households with only one indicator of financial stress. So it doesn't take a lot. I mean, the standard explanation for financial stress, it's about households, someone losing a job, about household like family breakup, so divorce. That's a major one, and also illness. And I mean, part of that is about the problem of slim buffers, that the way that household balance sheets are constructed, especially with high housing costs, but there's a series of issues there. What we see is households having slimmer buffers than they used to. They're exposed to more fixed costs. Costs are rising, especially on housing, but in a lot of spaces, and that leaves very little space for households. That leaves very slim buffers. And so we do see that financial stress is not only a problem for, households with, major issues, or, there's nothing special about financially stressed households. They're right up and down the income ladder, and they're ordinary households.
Okay, great. So I've got a question here about whether you've looked at changes in household responsiveness to financial stress over time, and in particular with regards to private health insurance. So an example given is, were households in financial stress in 2009 more or less likely to respond to financial stress by reducing insurance coverage than in the more recent year? I forgot what year you were using.
2015.
2015, yeah. Have you looked at that or not?
Not really. So no. So I've simply combined those two different waves. It's not panel data, of course, but I've combined those two different waves simply so that I can have big enough sets of samples, right, because once you're drawing down there. But no, there has been considerable work done here at the Melbourne Institute on medical insurance particularly. But yeah, I'm not, I can't say much there, unfortunately.
Great. Now, someone's raising an issue of whether insurance should be seen as a necessity or a luxury good, and I suppose one of the perhaps questions is is it rational? Is this a rational response to financial stress to reduce insurance coverage? And perhaps relatedly, do you know? Have you looked at the extent to which this is people reducing their coverage, for example, increasing the deductible and reducing the sum insured, that sort of thing, versus just opting out of insurance, just dropping insurance altogether? The former might be sort of seen as perhaps a bit more rational than the latter. And also, I noticed that much of your effect was on health insurance, and I guess the important distinguishing feature there is we do have a public option for essentially the important parts of the medical system. The private health insurance, what it adds on top is kind of a luxury good. So what is it appropriate to think of that, particularly that health insurance, as a necessity rather than as a luxury good? And is it rational? Are these really perhaps rational responses?
Yeah, good. Look, we can't tell from this data if people are opting out of insurance entirely or if people are reducing, like dropping their cover down. And that is something that I do want to look into more, but it's difficult to do that. But I think we can say in any case that if we're seeing reduced spending, because this is an insurance expenditure, if we're seeing reduced spending, we can fairly safely assume that we're seeing reduced coverage, risk coverage. I agree that health insurance in Australia is complicated, clearly. I think what is less complicated and more problematic, though, is house insurance. And I think that's much more important for me, at least. I think that's the big issue here, not so much health insurance. We're seeing huge rises in housing insurance premiums, which is really posing a very real set of problems for households and for society and for policymakers. So I think what's really important here is house insurance, but we do see similar dynamics in health insurance. I guess that just supports the findings that we're seeing patterns here.
I guess with the health insurance one, I'd be particularly interested in whether, for example, in a country like the US, where the public option is rather minimal in what it provides, has there been research looking at this issue for other countries, like in particular the US?
I haven't been able to find any research on this question. I think partly the data is quite tricky. I think that's probably a part of the reason. But yeah, it would be very interesting to see how this pans out, because certainly I think what we see there with the car insurance being treated quite differently. I mean, that tells us something too, doesn't it? I mean, the risk of having a car accident is much higher than the risk of having your house burned down. But at the same time, the risk of having your house burned down is very problematic. And increasingly, we are exposed to risks from adverse weather, be it hailstones or bushfires or floods. It's a really important set of issues. And I think it's really a rising set of issues.
Could you interpret your finding on house insurance as evidence of moral hazard, that the people with the higher risk, for example, in bushfire-prone areas, perhaps they are rationally thinking, well, if a bushfire sweeps through here, there will be government support will come, and there might be charitable efforts made and so forth to help out. Whereas if I crash my car, no one's going to come and help me there. Do you think that this could be interpreted as some evidence of that moral hazard?
Absolutely, absolutely. And I mean, we saw after the bushfires, there was huge supports going into those areas, which was absolutely necessary and reasonable. And, you know, of course, but this is, you know, that's what I'm trying to say. Those problems are only going to get bigger as more and more people are, excuse me, are uninsured. Yet as we continue to have these huge calamities where the state has to step in. I mean, you know, otherwise we end up in a kind of pre-Great Depression situation where households are just not protected, and that's, you know, that's a social problem.
So you've kind of set this up in the context of, you know, the pandemic-induced recession and the likely consequences that has for financial stress. Do we have any sense of what has happened to financial stress over the last year and a half? And you know, is financial stress indeed correlated with the business cycle? Do you think is it something that has spiked, or is it something perhaps we're at greater risk of seeing an increase of going forward as perhaps some of the income supports are you know, like JobKeeper and the coronavirus supplement, and now that they're being removed, is it now where we're entering a more dangerous period?
Well, I mean, certainly we saw financial stress spike with the pandemic, and certainly there, for many segments of society, their stresses that continue to be a real problem. So yeah, I think, yeah, there is a real pandemic aspect to this, and it would be interesting to see, but again, it's very difficult with data to be able to evaluate this particular situation in the present moment. But I think we also have a kind of long-term shift towards more choppy finances. I mean, households are more exposed to financial risk than they have been before. And, you know, it's not the 1950s anymore. Households are much less secure than they used to be. So, you know, that's also part of the reason, along with the kind of slim buffers thing, that we see households moving in and out of financial stress much more than we used to. So, yeah, it's a very real set of problems.
Yeah. Okay, well, we are unfortunately out of time. Although, you know, you've just sort of started me thinking about a whole new line of questioning on that front about sort of, I guess, greater vulnerability in general to financial stress. But we will have to hold that over for another time. So let me thank Antonia for her presentation, and also thank you, the audience. I hope you've enjoyed this colloquium, and I look forward to seeing you at our next one, which is on the 22nd of June. That's where we'll have Dr. Jan Kabatek presenting on the academic achievement of children of same-sex and different-sex parented families. So please look at on our website over the next few days for how to register. So we don't have the links currently available as yet, but we will over the next few days. So thank you, and until next time, goodbye.